today what we're going to talk about, one of my sons asked me a two-part question really. One, how do you value a company and know if it's overvalued or undervalued, especially after you paid a lower price and as it starts to go up. Then the second question was, he knows I'm a big reader of The Intelligent Investor. It was the first book that I ever read. So he said, besides speculation versus an investment, what other 3 or 4 things did you learn that was real important that you got out of Intelligent Investor? And both of those were really outstanding questions. We're going to first start with how do you value a company? I would say the first thing you got to do is, in the past videos, we talked about how do you identify a company. And then the second thing you should do is how do you value that company? And the easiest way to, there's a couple ways to value a company, but the two easiest ways to try to get the most accurate ways is the price to earning ratio and also discount cash flow. Discount cash flow is basically how much a company is going to earn in the future. And you can go and download formulas that they have, that you can actually put this information in, but how much money a company is going to earn into a future. So just to talk about the discount cash flow spreadsheet. So if you put in today what they earn, and then you can go out and predict out in future growth. So let's say you picked a company that you knew was going to grow at 5% a year for the next 10 years. You can put that information into a discount cash flow formula, and it'll give you the current price that is today. So basically, when talking about that, a company is worth how much money they're going to earn in the future. And the way that you can tell that is the price to earnings ratio. Like the overall stock market had a price to earning ratio. I believe the medium over the years of investment, I believe it's 18. And I believe today's stock market is trading a little over 20, which will kind of tell you that the overall stock market is a little over on the high end side of normal. And in those type of markets, I don't like to invest in. But with a company, you're going to have an average. Let's take a company like Amazon. Amazon has always been hard to use the price to earnings, but we're going to use it in this scenario because they got a forward price to earning of a 40. And believe it or not, which is high for most companies. Microsoft is at a 40, I believe, which Microsoft used to average around 15. So I believe Microsoft is extremely overvalued, even though they're growing their earnings really fast. But I believe a 40 PE is a stretch. But what makes Amazon 40 PE a little bit different from Microsoft is Amazon is still growing rapidly. And they've always so heavily invested in AWS, and they built major warehouses around every metropolitan area in America so they can get to one-day delivery. So they spent all this money investing from their very beginning, back when it was just a online bookstore. So they've always just reinvested. And now I think you're going to start seeing more of that. Not less reinvestment. They're projected to spend $100 billion in projects and research and development, but you're going to start to see that come down. That overall $100 billion is going to come down to how much revenue they're going to be producing, and I believe that at a 40 PE, that's pretty low. Let's take something like Meta. Meta normally averages around a 20-something PE. Right now today, from earnings, is selling at about a 30-something. Forward PE is selling at about a 20-something, about a 21, 22, which, if you're using a forward PE, would kind of tell you that that Meta is maybe undervalued at this point. I really don't like to use forward PE. I do like to use that they're going to grow their earnings, so it can give me an idea from where their PE is at now to where their PE could possibly be if they make all their earnings. And a lot of times, Meta, they beat their earnings. So that's one of the best ways to value a company is by looking at their average PE and where they're trading at, today. And which I'm going to, and the reason why I combine these two, because I'm going to use what I learned from the Intelligent Investor to also help how you come up of what you think something is overvalued or undervalued, and when is a good time to invest. Now, answering this question with 5 things that I learned was actually kind of hard, because I read a lot of books like, let's say, a Dave Ramsey, stuff like that. Those are more motivational financial speakers. They don't really tell you how to become a better investor. Intelligent Investor, which after I read The Making of American Capitalists by Warren Buffett, said it was the best book that he ever read. So I knew at that point I had to read it. And it was the first book that I read that really broke down how to invest in individual stocks. So everything that I learned, the foundation of everything that I learned came from The Intelligent Investor. The first time I can ever remember really learning about the price to earnings and how to utilize that came from The Intelligent Investor. One of the most important things that I still use and think about even to this day, he has written in there about Mr. Market. And Mr. Market is about, and let's say you own a company or a store and you have a partner with you, y'all both 50-50. And every day he comes to you with a stock quote and asks you, do you want to buy or do you want to sell? One day he may, let's say if the stock is trading at 50, one day he may come and offer at 100. You may find that to be a fair or high price, and you may sell. He may offer you at 20, and you would tell him no way. And I believe, because that's it's in chapter 8, which is market fluctuations, which basically talks about how the market is always going to fluctuate, day to day, year to year. You don't have to pay attention to it. You can pay attention to it, but you have to use it to your advantage, when the market fluctuates. So if the market is up, as it is today, you may not want to be a big purchaser of stock unless you can find something, really, really good in the stock market that's completely undervalued, or when you want to buy when the stock market is low. Because in most cases, when the overall market goes down, pretty much everything goes down, which is a lot easier to find really good value stocks at that point. It taught me the qualitative and qualitative factors, and what to look for in the intelligent investors. Quantitative factors being the numbers, going over the books. I recommend to anybody out there that's investing, you take a couple, 1 or 2 or 3, or on your own, learn some accounting. Accounting is the business language, and stocks are businesses. So you want to be able to know the quantitative factors, and you want to be able to look at the qualitative factors. What business are they in, and what is the long-term outlook for this business. Then we talked about margin of safety. Margin of safety, which is a big part of the culmination, which we call it the risk-free rate, because we're basically basing a lot of our investments on the risk-free rate of the government bills, is which, when you're doing a formula, you use the risk-free rate of the government bonds. So, and that's the number one factor, and everything is based off of that. We're buying in the overvalued market. We're buying bonds with fresh capital. We're waiting to the market to fall, and you normally it's easier to invest in. If you don't want to pay a lot of attention to companies, it's easier to invest in the SPY or the QQQ, which is going to give you the SPY, the top 500 companies in the S&P, or the 500 companies in the S&P 500, and the QQQ, the NASDAQ 100 stocks. The NASDAQ is going to have a lot more fluctuation, but I believe it'll have a lot more upside to it too. Also, I also learned never buy new issues was a big part, of it. And the reason why he says never buy new issues is because they're selling something. When they're issuing new shares of a company, they're actually selling a portion of that business. And in most cases, they're not going to sell that business. They're not going to sell the business undervalued. Most cases, they're going to sell it overvalued. And a lot of times, new issues are unproven. Like in 2000, when all these issues was coming out, all these new stock issues was coming out, and most of them ended up worthless. But the bad part about that is that, Amazon came out at that time, which, ended up being one of the greatest, companies in the world. But you have to act, but did I know, or did anybody know that when Amazon was just only selling books and then they went to CDs, that it would turn into what it is today? Graham saying just stay away from those. That's pretty difficult task to complete. And if I had to guess, you're not going to make very much money investing that type of way. The 3 reasons why stocks can become undervalued. And you should notice to look out for it. The overall market just comes down, as I stated earlier. Almost all stocks fall when the overall market is coming down for whatever reason that it may be. The overall, it could create value. The stock is just being ignored in the market for some reason. People are just not paying attention to it. It's not making a lot of noise, and then the stock just drifts to undervalue. And then also they're going through temporary problems. I know back, when Buffett was well known for American Express, they had these big containers full of oil, and come to find out some of them didn't have oil. They had water in it, and so they had a value of the oil, in these tankers, and so they had to mark it down. And Warren Buffett, he originally invested in American Express. So you're just going through a temporary problem. A good temporary problem that happened not too long ago was with Meta. Apple changed their coding and how Meta could track people's cell phones to advertise to them. They changed that, and that was one of the main reasons of why the stock drifted all the way from 384 all the way down to 90. Besides that, the overall market came down. I think they came down a lot more because of that. And so those are 3 ways, something that I learned from Graham, 3 ways. Also, to look at companies, this is back to Mr. Market, and this is probably most important. I probably should have started off with this, is that when you're making any investment, you shouldn't look at the price of the stock as formulating your investment. You should look at the total market cap, which is the number of shares times the price of the stock, to become up the overall value of a company. This is Graham. I don't think he didn't invent it, but he was one of the main. When he originally wrote The Intelligent Investor, people walked away. He was the main one to look at stocks as the company and businesses that they are. So let's just take Meta for an example. Let's use NVIDIA, because NVIDIA is up 102 today. And I wouldn't buy NVIDIA. But NVIDIA, last year, fourth quarter, NVIDIA made $1.4 trillion. 1 year later, because of AI chips, they made $12.45 billion yesterday. And the only reason I wouldn't invest, and so NVIDIA right now is selling, it's coming up on $2 trillion. So that's basically, let's say if for four quarters in a row, if NVIDIA made $48 billion in a year, would you buy NVIDIA for $2 trillion? And so what's going to matter is, what is NVIDIA going to do in the future? Are they going to grow from that 48 billion? So let's say next year, if they make 100 billion and they're selling, and you bought it for 2 trillion, then you're basically buying it 20 times earnings, which is not that bad. But I've been through chip cycles. I don't like chip cycles. What's more than likely going to happen, Micron, Intel, AMD, they're working in, I'm sure they're in the lab right now, formulating their own chip. This is how capitalism works. They're formulating their own chip for AI. They're going to more than likely mark theirs less than what NVIDIA is getting for theirs today, because NVIDIA is mainly the only one making them. So it's going to bring the price down. NVIDIA is going to have to bring their price down. And if I had to guess, they're going to oversupply the AI market, and the chip stocks are going to fall, which is why I would prefer to play AI on companies like Amazon, Facebook. What are the software users going to do with the chips? What are they going to do with AI to make money? And then one other thing that we learned is, and he'd done this a couple times in Intelligent Investor, he compared 4 different companies. So he may compare 4 different companies in the same industry to, you can if they're in the same industry and they're selling the same product, You have to see which one mainly has the advantage by brand name, and then you also, and then which one is the most financially sound, and also have the best leadership at the time in deciding your investment. So he tells you how to compare four different stocks in the same industry and four different stocks, let's say, in different industries. You know, what's the difference in Amazon and Verizon being valued, and which one should have the most value? Verizon isn't growing very much at all. It has a nice dividend, but it's not growing very much. Amazon is still growing, at 20-something%, a year. Amazon is going to command a higher price to earnings than Verizon. And then you have to see what cycle it is. Is Amazon at an all-time high? Is Verizon at an all-time low? And in comparison to different companies, it'll help you formulate where you think the value at, and which investment you think is the best investment at the time. The last thing I want to talk about is something that I learned from Ben Graham that actually didn't help me out. Actually hurt me in my investment. Throughout The Intelligent Investor, Ben Graham he talked a lot about book value. And what book value is the assets that a company holds to come up with how much their book value is. So let's say you take a company like General Motors, who got factories, buildings, a lot of inventory. So they're going to have a lot higher book value than, let's say, take something like Microsoft. Microsoft really only have buildings, and that's pretty much it. It's a real low asset-based company, but Microsoft is at $2 trillion. If I had to guess, General Motors is probably at like 50 billion. But Microsoft don't need a whole lot of assets because they sell software to make a lot of money. And how that hurt me was I used to pay attention to book value, which kind of turned me away from some of these low asset companies that have high margins. And also, one of the things that I wasn't told or wasn't aware of at the time is that Ben Graham used book value, and Buffett also did, but he kind of stopped. They used book value because they used to go in, let's say if it has $100 million in assets and the overall market capitalization is selling for 50 million, and if you can go in and buy the majority of the shares at 50 million, and you can liquidate the company and it has assets of 100 million. And sometime in Graham's day, there was companies that was selling, the value of the enterprise was selling below the cash on hand of the company. So those are easy investments. You go in, you buy up the shares, you can basically close the company down, sell off whatever hard assets they have, and you would have made enough money because the cash now that's on the books of the company is now yours. And so that was something that he really didn't talk about too much in the book, but that was the main reasons why he used book value. And so I'm basically just telling you, book value ain't something that you need to put a whole lot of importance on unless it's banks. Banks, you want to buy banks at book value and below because their book value is the cash that they have on hand, and banks make money mainly off of cash. So that's why banks are important. Like right now, Citigroup is selling, I believe, at almost 50 times book value, where a company like JP Morgan is almost selling 2 times book value. So if JP Morgan's book value, let's say, is 100 billion, it's selling at 200 billion. If Citigroup's book value is 100 billion, it's selling at 50 billion. So you with just that alone, even though JP Morgan is one of the best ran banks in the world, and Citigroup still got a lot of problems way back from 2008 that they're still working through. You got to believe one day that Citigroup's book value, that they're going to be selling that book value, and you hope that they can move the stock more towards 100 billion than the 50 billion. But that's not exactly what their numbers are. I just made those up to kind of make it easy, for y'all to understand.